Insurance, what it is and why you need it. Does your health affect your wealth? Yes. People who engage in problematic health behaviors accumulate less wealth than others. But according to a recent brain research study, most people fail to see the association between health and wealth. Because they separate events, actions, and attitudes into mental categories that are valued differently. They have one mental category for health behaviors and another for wealth behaviors. So they have trouble seeing how health and wealth activities affect each other. Human capital and health. Human capital encompasses your ability and willingness to work, learn, earn, and make wise decisions about how to save and invest money. So human capital is one of your most valuable assets. As you develop strategies to safeguard your human capital, keep in mind, as you progress in education, experience, and training, your human capital will increase. Increased human capital usually results in higher yearly earned income. Higher annual income creates the financial capacity necessary to reach your goals. But there are also risks to your human capital.
Answer verbal question 1 now. What does increased human capital result in? What does increased human capital result in? Pause the video and answer verbal.
Relationship between health and human capital. Perhaps the single greatest risk to one's human capital is deterioration of personal health. If your health declines, it's more challenging to make and save money. Though you may still be employed, you might end up spending more on health care. If your health worsens, you may not be able to work. Without preparation, a single negative health event can destroy years of human capital development. And your financial goals, and the financial goals of those who depend on you, can quickly move out of reach. As long as you act while you're healthy, you can protect yourself from most unexpected events. The risk matrix and health. It's important to think about strategies to deal with life's threats and risks. There are many threats to good health. Some are common, such as the growing problem of obesity. Others are sudden and catastrophic, such as injuries from a car accident. A decision matrix is often used to classify risks and develop appropriate strategies to manage them. You can use this matrix to help manage your health situation, as well as other decisions with personal or household risk. Consider someone who often texts while driving. The decision matrix shows both the likelihood, frequency of the risk, and the severity of a car accident while texting are high. The rule for situations in which the frequency and severity of risk are high is to avoid the risk. To avoid the risk, don't text while driving. On the other hand, some events are unlikely, and if they do occur, the severity of loss is low. Take checking a bag while flying. The probability of the airline losing your bag permanently is very low. If lost, the severity, though annoying, is also low, assuming you did not pack high-value items in the luggage. Based on the rules in the risk matrix, you should accept the risk rather than avoid flying or buying insurance for lost luggage. Based on the frequency and the severity of a risk, management techniques can be used to minimize negative outcomes. For instance, the best way to minimize the high probability and high severity risk of car accidents while texting and driving is avoidance. Don't text and drive. On the other hand, anyone may become sick or injured, and aging brings additional health challenges. Most often, these types of health risks can be classified as low frequency and medium severity. We discuss how to protect against these types of risks next. Protecting your health. Unfortunately, sometimes just avoiding health risks is not possible. So you also need to learn how to manage health risks through 2 strategies: behavior modification and health insurance. Behavior modification. The major factors that determine how healthy you are today and will be in the future are health behavior, genetic disposition, social circumstances, medical care, and the environment. Note that your behavioral choices are the single greatest determinant of your health. These choices relate to your daily activities, including diet and exercise, safety practices like wearing seatbelts, stress management, avoidance of substance abuse and addictions. This means that your health is significantly under your control. One of the significant factors is eating healthy. Healthy eating. As you hopefully now realize, maintaining good health is key to achieving your financial goals.
Answer verbal question 2 now. What is the second strategy mentioned to manage risk? What is the second strategy mentioned to manage risk?
Yet nutrition rules and exercise plans can sometimes seem confusing and conflicting. How do you make sense of it all? Consider Francisco, a junior in college who is slightly overweight. He's committed to improving his health and just learned that the U.S. Department of Agriculture has resources to help people make healthy eating choices, including information about the major food groups and how much should be eaten from each group on a daily basis, an online nutrition tracking tool. Just like tracking his expenses helps Francisco understand where his money is going on a monthly basis, tracking what he eats can help identify poor eating habits. Francisco also found information at the Centers for Disease Control and Prevention's website, including research and other information about stress management, sleep patterns, disease prevention, and mental health, ideas for exercise programs, and how much he should strive to do each week. Francisco soon realized that good health is not just about eating right. It also includes moderate exercise, adequate sleep, good safety habits, and avoiding alcohol, drugs, tobacco, and unhealthy relationships. If Francisco maintains his new healthy habits, he should see a short and long-term increase in his human capital. He should feel better and perform at a higher level in his classes. This should result in better grades. If he sticks to it, he'll likely improve managing other aspects of his life as well, including making better financial decisions, which will increase his chances of accumulating wealth over his lifetime. Health insurance. Another way Francisco can manage risk to his health is to transfer the risks and costs associated with health-related events to an insurance company. Overview of insurance companies. Insurance is the primary way people transfer risk of a loss to another party, like an insurance company. To take on your risk, an insurance company will charge 1. A premium, the cost of the insurance. 2. A deductible, the amount you must pay on a claim before insurance comes into play. 3. A copayment, a cost-sharing amount with the insurance company. Nearly all insurance companies operate under similar guidelines and procedures. Insurance companies build large portfolios of assets by pooling and investing premiums, the cost a consumer pays for insurance, from thousands, if not millions of individuals. They use the earnings from these investments to pay claims for those affected by an event. This helps spread out the severity associated with a few high-cost events. If the severity and frequency of a risk increase, then so will the premiums insurance companies charge. This is true whether the risk is related to your health or property. Always remember, insurance companies are in business to make money. They want to minimize their risk, as they make money by offering insurance on low-frequency events that do not generally result in extremely high losses. Over time, insurance companies may decide to cancel policies or stop issuing new policies. This can occur when insurance companies conclude the frequency of an event is greater than expected, or the cost of paying claims is too high. Let's look at flood insurance. Homeowners can no longer purchase flood insurance from private insurers. Because the frequency of significant flooding is high and the severity of losses often catastrophic, private insurance companies pulled out of the market. Without insurance, homeowners in flood-prone areas face large potential losses. The federal government stepped in to provide subsidized flood insurance to those living in areas with a history of flooding. Homeowners can now purchase flood insurance from the Federal Emergency Management Agency, FEMA. Insurance is designed to compensate the policy owners only up to the value of their loss. This is the principle of indemnity. If an insurance company believes one person or a group of people are making claims primarily to profit from a loss, the company can dispute the claims or cancel policies.
Answer. The principle of insurance companies only compensating individuals up to the value of the loss is known as blank.